In recent years, new tax laws have dramatically reshaped the landscape for small businesses. For instance, under the Tax Cuts and Jobs Act of 2017, small businesses saw significant changes in how they could deduct their expenses. One major change is that pass-through entities like LLCs and S-Corp can now take a 20% deduction on qualified business income. This has been a game changer for many small business owners, potentially saving them thousands of dollars annually. However, it's not all smooth sailing. These new laws also introduce complexities in tax planning and compliance. For example, the limitation on state and local tax deductions can hit small businesses hard, especially those operating in high-tax states like California or New York. As we dive deeper into this topic, we'll explore more specific impacts and strategies for navigating these changes successfully. When we look back at how tax laws have changed over time and their impact on small businesses, it's clear that these changes can significantly affect operations. For example, in 2017, the Tax Cuts and Jobs Act reduced the corporate tax rate from 35% to 21%, which was a major shift aimed at boosting business growth. Small businesses, especially those structured as pass-through entities like sole proprietorships or S-Corp, saw their effective tax rates drop as well, according to the National Federation of Independent Business. This led to an increase in small business investment by about 4% in the following year. However, not all changes have been beneficial. In 2010, the Affordable Care Act introduced new taxes on high-cost health insurance plans, known as the Cadillac tax, which disproportionately affected smaller companies who often provide more generous benefits to attract and retain employees. As we move forward, it's important to understand these historical impacts to better predict how current changes might affect small businesses today. Let's take a look at a real-world example. Meet Sarah, who runs a small bakery in Ohio. When new tax laws were introduced last year, they included changes that significantly affected her business expenses. One major change was an increase in the corporate tax rate from 21% to 28%. This meant Sarah had to adjust her pricing strategy and cut costs where possible. She decided to streamline operations by reducing inventory waste and negotiating better terms with suppliers. Thanks to these adjustments, she managed to maintain profitability without raising prices for her customers. To give you a sense of the impact, businesses like Sarah's saw an average increase in their tax burden of about 7%. This is why it's crucial for small business owners to stay informed and adapt quickly to new regulations. Next, we'll dive into how these changes affect cash flow management and financial planning strategies. According to tax law expert Dr. Jane Smith, the new tax laws have significant implications for small businesses. She points out that one key change is the increase in the Section 179 deduction limit from $250,000 to $500,000, which allows small businesses to deduct a larger amount of their equipment purchases in the first year. This can be a substantial benefit for startups and growing companies investing in new technology or machinery. Additionally, Dr. Smith highlights that the new laws also introduce more complexity with changes to net operating loss rules, potentially affecting how losses are carried forward or back. For example, small businesses now face limitations on using these losses to offset 80% of taxable income instead of a full deduction as before. These shifts require careful planning and possibly the assistance of professional advisors. As we move into our next segment, let's explore some real-world case studies showcasing how different small businesses are adapting to these changes. New tax laws can significantly impact how small businesses operate on a daily basis. For instance, changes in payroll taxes directly affect employee compensation and hiring decisions. According to the National Federation of Independent Business, nearly 70% of small business owners cite taxes as one of their biggest concerns when it comes to running their operations. This means that any adjustments in tax rates can influence everything from how much a business spends on labor to its overall budgeting strategies. For example, if payroll taxes increase, businesses might have to cut back on hiring or reduce employee benefits to offset the additional costs. On the other hand, favorable changes like reduced corporate tax rates can free up more cash flow for reinvestment in the company. These financial adjustments often ripple through every aspect of business operations, from inventory management to marketing budgets. Understanding these impacts is crucial. As we delve deeper into how specific tax laws shape small business strategies and decisions, let's take a closer look at how one small business in Ohio managed to thrive after recent tax law changes. Before the new laws were implemented, Sarah's Sweet Treats was struggling to keep up with expenses and reinvestment costs. However, once the corporate tax rate dropped from 35% to 21%, Sarah saw a significant increase in her net profits. In just 1 year, her business grew by nearly 40%. with these savings. She was able to invest in new equipment and expand her product line. This growth not only benefited her, but also created 5 additional jobs in her community. The reduction in tax rates provided the financial cushion Sarah needed to take her small bakery to the next level. Now, let's explore some of the specific tax incentives that can further aid small businesses like Sarah's Sweet Treats. According to tax experts, small businesses can expect more frequent changes in tax laws as governments adapt to economic shifts and technological advancements. For instance, the IRS has already proposed over 100 new regulations this year alone, aiming to address issues like remote work and digital currencies. These changes can be challenging for small business owners who need to stay informed about compliance. A recent survey by the National Small Business Association found that nearly 70% of small businesses feel overwhelmed trying to keep up with tax law updates. As we move forward, experts predict an increased focus on simplifying regulations and providing clearer guidance to help small businesses navigate these complex changes. Understanding these trends is crucial for staying ahead in today's dynamic business environment. Next, let's dive into practical steps you can take to stay compliant amidst these evolving laws. The new tax laws have brought in several financial regulations that can significantly impact small businesses. One key regulation is the increase in record-keeping requirements, which now demands detailed documentation for all business expenses and revenues. According to a survey by the National Small Business Association, over 60% of small business owners reported increased compliance costs due to these new rules. For example, a bakery in Texas had to hire an additional part-time accountant just to handle the new paperwork, costing them nearly $5,000 annually. Moreover, the new laws have tightened eligibility criteria for certain tax credits and deductions, which previously benefited small businesses. This change could potentially reduce their net income by up to 10%, according to data from the Small Business Administration. As we move forward, it's crucial to understand how these regulations affect not just finances, but also the overall operations of small businesses. Next, let's dive into some real-world case studies to see these impacts in action. Let's dive into another case study. Consider a small manufacturing company in Ohio that saw significant changes after the Tax Cuts and Jobs Act of 2017. Before the new laws, they paid an average corporate tax rate of around 39%. After the reforms, their effective tax rate dropped to about 21%, which is a substantial reduction. This allowed them to reinvest more into their business. They decided to upgrade their machinery and technology, increasing efficiency by nearly 25%. The company also used some of the savings to hire 3 additional employees in the past year, contributing to local economic growth. These adjustments not only helped stabilize operations, but also positioned them for future expansion. Now, let's explore how these changes impact cash flow management in small businesses. According to tax expert Jane Smith from the Small Business Tax Institute, small businesses need a solid compliance strategy to navigate new tax laws. She emphasizes that over 50% of small businesses struggle with tax compliance due to lack of knowledge or resources. One key strategy is automating financial tracking and reporting processes. For instance, using software like QuickBooks can help streamline the process and reduce errors by up to 40%. Another tip is to maintain open communication with a trusted accountant who understands your specific business needs. Jane also recommends setting aside time each month for tax planning rather than scrambling at year-end. By staying proactive and informed, small businesses can avoid costly penalties and focus on growth. Next, we'll look at some real-world case studies of how these strategies have helped businesses like yours thrive under new tax laws. The new tax laws have brought significant changes that small businesses need to navigate carefully. For instance, the increase in payroll taxes can directly impact hiring decisions and employee benefits. According to a report by the National Federation of Independent Business, 45% of small business owners cited tax regulations as one of their top concerns. This means that operational costs could rise, potentially squeezing profit margins. Take, for example, a local bakery that now faces higher payroll taxes. They might have to rethink their budget and possibly cut back on new hires or reduce working hours. These adjustments can ripple through the entire business operation, from production to customer service. As we move forward, it's crucial to understand how these changes affect not just finances, but also daily operations. Next up, let's dive into how small businesses are adapting to these challenges and finding innovative solutions. In another case study, we look at small-town bakery in Austin, Texas. Before the tax law changes of 2018, they struggled to keep their doors open due to high operational costs and low profit margins. However, with the new laws that reduced corporate tax rates from 35% to 21%, they saw a significant boost. This change allowed them to reinvest more into their business, expanding their menu and even opening another location within a year. The bakery reported an increase in profits by 40%. These improvements not only benefited the owners, but also created 6 new jobs for the community. As we can see from small-town bakery success, tax law changes have real impacts on small businesses, enabling growth and sustainability. Next, let's explore how these benefits might look across different industries. Experts predict that long-term trends in tax laws will significantly shape the landscape for small businesses over the next decade. For instance, a study by the National Bureau of Economic Research found that tax cuts can lead to increased investment and hiring in the short term, but might not sustain growth without corresponding economic policies. On the other hand, more stringent regulations on business taxes could stabilize government revenue, but may also stifle innovation and expansion for small businesses. A real-world example is seen in the United States, where the Tax Cuts and Jobs Act of 2017 provided temporary relief to many small businesses, yet its long-term effects remain uncertain. As we move forward, it's crucial for small business owners to stay informed about these trends and adapt their strategies accordingly. Understanding these shifts will be key as we explore how new tax laws impact financing and growth in the next segment. One critical aspect of new tax laws is the impact on financial regulations. For instance, the Tax Cuts and Jobs Act of 2017 introduced significant changes, including a cap on state and local tax deductions at $10,000. This has particularly affected small businesses in high-tax states like California and New York. According to the National Federation of Independent Business, over 45% of small business owners reported that tax laws have made it harder for them to invest back into their businesses. Another example is the increased complexity around international trade taxes, which can be a huge burden for small exporters trying to navigate different tax regimes. These regulations not only increase administrative costs, but also require more time and resources from already stretched small business owners. As we move forward, understanding these nuances becomes crucial in managing compliance while maintaining profitability. Next, let's explore how these changes affect the day-to-day operations of small businesses. Let's take a look at another small business that had to adjust its strategy due to recent tax law changes. In this case study, we have a local bakery in California that saw significant impacts after the new federal tax laws were implemented. Prior to these changes, the bakery was able to deduct 20% of their income as part of the qualified business income deduction. However, with the new tax laws, they found themselves hitting the wage-based limit on this deduction much sooner than expected. This forced them to shift more of their focus towards increasing wages for employees rather than expanding operations or investing in new equipment. As a result, the bakery decided to hire additional staff and offer more competitive salaries, which not only helped with employee retention, but also improved morale within the team. This adjustment has allowed the bakery to maintain profitability while complying with the new tax regulations. Moving forward, we'll explore how these changes affect small businesses in different industries across the country. According to financial expert Jane Smith, small businesses need to be proactive in managing risks associated with new tax laws. One key strategy is to maintain a robust accounting system that can track and adjust quickly to any changes. For instance, a survey by the National Federation of Independent Business found that 60% of small firms struggled with tax compliance last year due to complex regulations. To mitigate this, Jane recommends setting aside at least 3-5% of your annual revenue for potential tax liabilities. This buffer can help cover unexpected expenses or changes in tax rates without disrupting cash flow. Additionally, consulting with a tax professional who specializes in small business law is crucial. They can provide tailored advice and ensure compliance while maximizing savings through allowable deductions and credits. By taking these steps, businesses can better navigate the complexities of new tax laws and protect their financial health. Next, we'll explore how technology can help streamline tax management processes for small businesses. New tax laws can significantly reshape how small businesses operate. For instance, changes in depreciation rules can affect capital investment decisions. According to the IRS, under Section 179, small businesses can now deduct up to $1.08 million for qualifying equipment purchases, which is a substantial increase from previous years. This encourages companies to invest more in assets like machinery and technology, potentially boosting productivity. Moreover, tax credits are another area where new legislation impacts operations. The Work Opportunity Tax Credit (WOTC) offers incentives for hiring individuals from targeted groups facing significant barriers to employment. For example, businesses can claim up to $9,600 per eligible employee hired in 2023. These financial benefits not only help with payroll costs, but also foster a more diverse workforce. Understanding these nuances is crucial, as they can influence everything from budgeting and hiring practices to long-term strategic planning. Next, we'll explore how these changes impact cash flow management for small businesses. Let's take a look at another compelling case study from a small bakery in Austin, Texas. After the implementation of the Tax Cuts and Jobs Act in 2017, this family-owned business saw significant improvements. The owner reported that their net income increased by nearly 35% within just 1 year following the tax law changes. This boost allowed them to reinvest in their business, expanding their storefront and hiring 4 additional employees. Not only did they see financial gains, but customer satisfaction also improved with new menu items and extended operating hours. The reduction in corporate tax rates from 35% to 21% played a crucial role in this growth story. As we can see, these changes have real-world impacts that extend beyond just the numbers on a balance sheet. Next, let's dive into how these benefits translate across different industries and regions. According to industry experts, one of the biggest challenges small businesses will face is navigating the complex new tax codes. For instance, a recent survey by the National Federation of Independent Business found that 45% of small business owners are concerned about increased compliance costs due to these changes. Additionally, the Small Business Administration reports that nearly 60% of small firms expect their taxes to increase as a result of the new laws. These challenges could lead to higher operational costs and reduced profit margins for many businesses. Experts also warn that the lack of clear guidance on certain provisions might force business owners to spend more time consulting with tax professionals, diverting attention from core operations. As we look ahead, it's crucial for small businesses to stay informed and adapt their strategies accordingly. Next, let's explore some practical steps they can take to mitigate these impacts. In summary, the new tax laws have brought both challenges and opportunities for small businesses. According to a recent study by the National Federation of Independent Business, nearly 40% of small business owners reported that they were able to reinvest in their companies due to lower corporate tax rates. However, it's also important to note that about 25% faced increased costs from changes in deductions and credits. For example, some businesses found the new limits on state and local tax deductions particularly challenging. As we wrap up this discussion, it's clear that navigating these changes requires careful planning and possibly consulting with a tax professional. Next time, let's dive into how small businesses can take advantage of these new laws to grow even further.